The price of gold is back down at just above the 1,200 level after having recently tested the $1,300 an ounce point. What's driving price action at present, and what could be the catalyst to move it again in the months ahead in either direction? Well, we're talking now to a fund manager who specialises in small cap gold producers. Angelos Damaskos manages the Junior Gold Fund. Angelos, welcome. We've spoken to you before about this, and I know that the dynamic of some of the price action of some of the smaller cap producers acts differently to some of the other aspects of the gold markets. But I want to get onto your fund in just a minute. But first of all, the price of gold. Today we've seen the VIX at 10, 12-year lows. This is the volatility index, and this some say is the fear index. This shows that investors are very much risk on. But gold is still above the 1,200 level. What's happening with the price of gold?
That's right. There is a lot of complacency in the market, Jeremy. As you pointed out, the VIX is at the 10-year low. The S&P is on a PE of 22 times approximately. The Nasdaq is at 33 times. So we are almost in bubble territory at all-time highs in the markets, as they have been propelled by the excessive liquidity available in the market. Yet, even though a year and a half ago, we tested the $1,000 an ounce for gold, we are back to $1,220. It shows that there is still a small segment of the market that is fearful of these levels in the global equity markets and is concerned about an imminent pullback. And naturally, they are looking to hedge, and gold has been inversely correlated to the market action, typically and historically.
Well, let's take a look at the IG sentiment wheel, because I think this indicates, interestingly, that we've got 77% of IG clients that are long on gold at the moment, which would seem to back this up. If we go back to the chart, if we can bring up the chart of spot gold, it has disappeared below what has been this rising support line that we've had, which for technical analysis, this potentially is worrying, but it still seems that there are a lot of long positions in the market. So there's a lot of fear out there, despite the fact we've got the volatility index lower. Over the summer, what are you watching which could move things either one way or the other?
Well, the key thing in my mind is the monetary policy. The central banks are pushed into a very tight corner at the moment. They have followed a very accommodative policy for the last 8 years or so after the financial crisis, which has the sole objective of stimulating growth. Now, growth has not stimulated to the long-term sustainable levels that they target. We have seen unemployment come back. That's a bonus, and that gives confidence to the market, but growth is still relatively weak. Now, the central bankers are facing significant risks whether they continue with the accommodative policy or they abandon it gradually and raise interest rates, because that could stoke up inflation and further hamper growth. So it would be very interesting to see how the central bankers behave in the next couple of months. Our feeling is that they are unlikely to go into a tightening stance and raise interest rates substantially, because that would weaken the global economy. And most importantly, we have seen some very dark clouds gathering with a sell-off in the bond market recently. Most notably, the biggest buyer of US Treasuries, China, has started selling recently for its own internal reasons, because they want to battle their debt problems. And most recently, even Saudi Arabia, one of the largest US Treasury holders, has been selling as a result of the crash in oil prices. So it's not going to be easy for the Trump administration to finance their infrastructure program, which is supposed to stimulate growth in the economy, because there'll be no one to buy their bonds.
Let's go on to another point I think that you've raised, which I find of immense interest, is that you come up with this figure which is in the market that only 0.5% of global financial assets are invested in gold and gold equities. This to me seems like almost a crazily low number. As we saw from the sentiment index, got a lot of people are long gold. It's 1,200 an ounce, well off the lows that we've seen over the last year, but well off the highs as well. But I'm surprised it's only 0.5%. Explain what's happening here.
Well, again, it indicates the complacency of the markets and how investors have been lulled into a false sense of security going into the main markets and the indices. And that is most notably in the mutual fund industry. There is very, very little pension or mutual fund money invested into gold or gold equities. And in fact, the 0.5% that we see today is almost half what it used to be in 2011 when we saw the spike of gold up to 1920 or so per ounce. So since then, we've had a 5-year bear market. A lot of people got disenchanted with gold, so there was a massive exodus. So the point we find interesting is that we found an analysis of the global market capitalization of the gold mining industry in the world, the quoted equities. And that is apparently approximately 522 billion in aggregate market cap. Now that is 2/3 of the market cap of Apple alone, which is market capitalization of 756 billion, with revenues of 234 billion per annum. Its revenues only are half the market cap of the global gold mining industry. So the point I'm trying to make is that if investors, for whatever reason, for geopolitical worries, for market worries of general uncertainty, decided to increase their allocation to gold, perhaps from 0.5% to 0.7%, there would be a massive demand for gold and gold equities that could push their prices dramatically higher.
And of course, this has an effect for you as a fund manager as well, doesn't it? Because, as I said, as a fund manager of small cap stocks, there could be some interesting developments if that was to be the case. Just before we get into a couple of stock picks I know you want to talk about, what's your attitude at the moment in terms of investing in this market? What are you looking for? What sticks out at the moment in the small cap space for gold investors?
Yeah, same as always. We are always looking for better quality companies with significant production, with existing reserves that have been proven and found and are on the path to commercialization. As well as strong management teams that have a successful track record in extracting the resources at a successful rate, and a solid balance sheet. So not excessive debt, nothing that could jeopardize the financial viability of the company in times of stress. We have shifted this a little bit lower in the market cap segment since the dramatic rally we've had during the course of 2016. Mm-hmm. One reason is that some of our earlier plays in 2016 became too big. And again, we are small cap focused, so we had to sort of downsize and look at further opportunities. But we are very optimistic about the portfolio quality. We think that they are all solid companies that not only will survive any weakness, but will prosper dramatically when the sentiment again changes to the next leg of the cycle.
I asked you to come up with a couple of stock picks, and within that index, I think you've chosen your two biggest picks. I want to talk about the first of those, Alexco Resources, which I think you've got a 5.5% fund weight on that stock.
That's right.
Why, and what is it you like about Alexco?
Well, Alexco is a relatively small company, market cap 180 million Canadian. It has cash of about 27 million and no debt, so it has a fairly solid balance sheet. It is not producing at the moment. It has a service activity that generates cash flow in the region of 3 to 5 million, so it has a sustainable cash flow to support the business. But it controls a mining district that has some of the highest grades of silver in Canada. And it was past producing. It suspended operations in 2014 because of the low silver prices, and they are now completing a feasibility study to bring it back into production towards the beginning of next year. It's going to be a fairly profitable operation. The all-in sustaining costs are expected to be in the region of $12 per ounce when the silver price at the moment is above 16, so very profitable indeed. And the company is extremely undervalued compared to its peers when you consider that the reserve that has been proven is in excess of 68 million ounces of silver. So it has a long mine life when it comes back to production, and it could be a very profitable operation.
Before we look at the second pick, I just want to talk about the silver aspect, because what we've spoken about gold, we presumably overlay the same sort of arguments of silver, do we?
Absolutely. The silver market is a corollary for gold, albeit a little bit more volatile than gold. In the 4 or 5 year bear market, the silver price fell much more than the gold price. And similarly, last year, we saw a bigger rise than gold. So we typically weigh approximately 20% of our fund to silver mining companies. And it just happens that Alexco has outperformed significantly many of the other constituents and has grown to become one of the top holdings because of the attributes I just pointed out. So we still are very bullish on silver. We think when the trend continues towards rising prices, silver can outperform gold. But at the same time, we like to keep control of the volatility because silver is much more volatile.
Yeah. Second pick is also a 5.5% fund weight holding is Resolute Mining. I think this is an Australian listed company, isn't it?
It's an Australian-listed company, but it has 3 producing mines. It's slightly bigger than Alexco at just under 1 billion Australian market cap. It has cash of about 275 million and debt of only 22 million, so significantly robust balance sheet. But it has 3 operating mines, one in Mali, one in Ghana, and one in northeast Australia. Which combined produced approximately 300,000 ounces a year at an all-in sustaining cost of US dollars 934, so significantly below the current spot prices. It's a very profitable operation. It has a very long mine life. The average mine life is in excess of 12 years for the combined operations. And it also has a very strong exploration aspect that could organically add to resources and to the production going forward. So we feel it's a very undervalued company compared to its peers. As a few metrics, indicative metrics, for example, the enterprise value to EBITDA is at 4.1 times compared to the sector of 10.3 times, and its price to net asset value is 0.8 times compared to the sector of 1.7 times. So less than half the sector averages, with a very solid balance sheet and a rapidly growing production base.
Yeah, okay. Well, as per obviously anybody in this sector, we're hoping that to see the prices rise over the summer. But Angelos, we have to leave it there. But thanks for joining us.
Thank you.
For that, 2 stock picks there, Alexco Resources and Resolute Mining, 2 of the largest holdings in terms of fund weight on the Junior Gold Fund, which is managed by our guest today, Angelos Damaskos.